Hi, it's Shane Williams here. I'm President and CEO of West Red Lake Gold Mines. West Red Lake is a developer in the Red Lake region of Ontario. We recently took over the Matson mine and we're bringing that back into production.
Shane, lovely to see you. Thanks very much for joining us here. Now, you kind of picked this up, it was last year, wasn't it? So you've had a bit of time to get your feet under the desk and work out what happened before and how you're going to fix it. So, tell us a little bit about yourself first, if you don't mind. We haven't spoken before.
Yeah. Look, my background is primarily project development and operations. I've been doing that for 25 years. I'm not a promoter type CEO. I'm more of a guy who's been building and operating mines for the last 25 years. So prior to this, I was with a company we call Skeena Resources, who your viewers will probably know as COO. So I was really there from the early days of advancing that project, from the developments and buying the deals off Barrick and moving them forward. And before that, I was with a company called Eldorado Gold, who some of your viewers will probably know, and spent a long time working on their Turkish mines, building and operating their Turkish mines, their Greek mines, Skouries project, which they're advancing. But more applicable to this operation is the Lamaque project in Val d'Or, which we ended up buying from Integra Resources, who you'll probably remember. And we basically took that over and put that into production in an 18-month timeline. And today it's actually operating as one of the best mines in Eldorado. So that's kind of what intrigued me about this opportunity, a sort of a quick restart back into cash flow. That's kind of why I ended up getting in.
Brilliant. It's a quick restart getting into cash flow if you get it right, because you kind of walked into a bit of a mess, right? You know, October 2022, this thing, care maintenance, put in protection from creditors. They got a bunch of stuff. Let me put it nicely. They miscalculated a few things, right? In their case, terminal. And I guess that what we want to get from this, and I'm sure lots of conversations you've had ever since you picked this up, is about how do you make sure you don't repeat those mistakes. So if you don't know what's broke, you can't fix it. So what went wrong in your estimation?
Yeah, sometimes these opportunities are good because you get to learn the lessons of past. Unfortunately for some of the shareholders and some of the management, really. What we really saw when we went in, Matthew, is we went in, we put a team together. It moved very quickly. You know, it was in the CCAA process. Sprott were the main lender. They were starring the process. Frank Juicer, obviously, who's our main shareholder, who is a lot of it successful in building resource companies. We quickly put together a team. And I went down with a team and we did our DD very quickly. And what we quickly saw really was there's a bit of a difference between the management approach to the project and the ore body itself. And it all kind of got mixed up in the one. You know, at one stage, it was the more hated asset in Canada because of the issues, because of the shareholders. A lot of people lost a lot of money on it. And however, we saw that as an opportunity, really. And when we went under and saw the deep dive of the ore body, look, they did get a few things wrong. Look, they took on a lot of debt. You know, there was a lot of debt on the project. They ended up taking on $150 million worth of debt from Sprott Resource Lending. And that had a lot of confidence that were not really flexible in a way. And one of them really was they needed to be in production by a certain date. And that really drove them on their approach to developing a mine. As you and your viewers will know, mining can be up and down. There can be a lot of challenges. It takes its time. It takes effort. And so having that, how would I say, over their heads really to force them into production, they made a lot of decisions which, you know, in the hindsight weren't the best decisions to move this project along. I'll give you an example, which is part of one of the reasons. They leased everything. They never put the capital into the mine that's needed in an underground mine. As an example, their primary crusher, which is a key part of any underground mine, was leased. It was a leased piece of equipment. All their equipment was leased. They had no camp in place. You know, everything was really, and I know they were out there and raising money and they raised money, but unfortunately they pushed everything to OPEX. So, you know, one of the things we saw was they never really intended to operate this mine, unfortunately. We saw that they were setting this up. The group that was there was it's the Oxygen Capital Group, who some people will know. They've brought a lot of mines forward and sold mines, but they haven't actually put a mine into production or operated a mine or built a company. And that makes a big difference. And you would probably notice, and your viewers, that it's a different skill set of early exploration, promotion, and actually building, constructing, and operating a mine. And that was a key thing that I saw. It made a lot of poor management choices. They brought in some people who were not the best, didn't understand what they were doing. They went into a part of the ore body, and some of your viewers might remember there was an area called the McVeigh Zone, which is where they did their primary mining at the start. It's more complex geologically than the other parts of the ore body. However, it's closer to surface, it's easier to get at, it needs less development, it could be drilled from surface. So when you're trying to show the market that you're in production, you're getting there quick, it's an easy one to get at. It's easy to get at, it's easy to show the market, yep, we're in production, we're working, everything is good. And, that was the approach. And, look, they're not the only ones and first ones ever to done that. Lots of other companies have tried to do that. Unfortunately, these systems in Red Lake are very deep and they're high grade, but they're very veiny and they're very complex. And they need a lot of drilling. And they need a lot of complex, detailed, fine drilling. And that was never done. And so if I look at the main technical issue that was done, that was it, really. In my mind, we saw that. They just didn't spend the time and effort in the drilling underground.
Yeah, and I think, obviously, we were talking about it before the show started, the report we did, running through some of the issues which happened. I mean, that's obviously a massive one. There are a lot more, I think, things other than just the money and the for instance, like the run of mine grade was much lower than expected. The cutoff grades. The list kind of went on a bit, and it just smack of what you just said of someone who's perhaps never built a mine before. And
it also comes back to that, sorry to jump in, it also comes back to that geological understanding, because they had one understanding in geology of how the ore body worked. And when they went underground, they went, oh, it doesn't work like this. So when you're underground developing stopes and mining, you're kind of hitting ore, then you're hitting waste. If you don't have good controls, you're hitting ore, hitting waste. Hence dilution increases, hence mining efficiency helps costs, and the grade gets lower. So it's kind of a build on from them. And look, they also had challenges with getting people, the right sort of people. They didn't have proper management support on the ground. They didn't have that. So all of those challenges kind of contributed to that,
Right. Okay. So, like I say, this isn't an exercise of what the hell went wrong. It's an exercise of, how do we succeed from this? How do we win from this situation here? So, and we'll get on to, your money raising, your drilling, etc., and your plan, more importantly. But just one other thing, want to make sure I understand in terms of what you bought or what you now own. Did you inherit any liabilities, financial or otherwise, in terms of things that you must do, things that you must pay for?
Yeah, look, the deal closed in June of last year, really. And so, look, on a pure valuation point of view, Pure Gold spent $350 million on this project. We picked it up for $6.5 million effectively, and some shares. We converted Sprott. Sprott had a large outstanding debt on the project. We converted that debt into equity. So from a pure balance sheet perspective of West Red Lake going forward, we have no debt on the books. However, when we picked up the asset, unfortunately, there was a lot of suppliers who were left in the lurch. There were suppliers, there was people, there was a lot of issues to sort out. So we sorted those out. We, as West Red Lake, inherited those. Unfortunately, no suppliers would give us credit. Everybody, it was owed money, and we had to work through those issues with the suppliers. There was bad reputation of unfortunately in the town, in the area from that issue. So most of those are behind us now. We've paid off all suppliers. We're back working on the ground. We've hired on all new people. Everybody got terminated. So we're back into good mode. We have 100 people on site now working, developing underground. So we're back. All that has been kind of cleaned up, as I would say.
Right. So you walked into a case where you've inherited $350 million worth of spend, some of it well spent and some of it not so much. Let's talk about, the decision making over the next few months, if not years. Okay. So we talked about, chosen mining methods. We talked about run of mine and dilution and cutoff grade and all of this sort of thing. Your way of getting around all those things and getting to a point where you can make an intelligent decision about the best strategy is what? Drill more, understand the ore body better. Is that it?
Yeah, fundamentally, that's what it comes down to. Before you can start to look at mining methods, how you're going to extract, what rates, we really need to understand the ore body. And this is one area that unfortunately, spent a lot of money, but they spent it in the wrong place. Unfortunately, the surface facilities are great, everything is done there, but the underground lacked capital investment, in my opinion. And a lot of these undergrounds are deep, and so you need the development, and you need development ahead, and you need drilling, and that really wasn't done to the level that should be for these mines. So we're going to spend the next 12 to 15 months, take our time, go underground, do all the development, set up the drill stations, and really drill about another 50,000 meters of underground drilling, which is very tightly spaced drilling, 6 to 8 meter drilling, very mine design level, production level drilling. And that's what really needed to be done prior to restart. And that's a plan. Actually, that's a plan that they knew they needed to do, really. Other people had told them, Sprott had told them, some advisors had told them, but at that time they were moving forward the market. They were a hot stock. They got to $1 billion. They were nearly there. They couldn't do it at the time for whatever reason,
It continually surprises.
Yeah.
But anyway, there we go. Right. With regards to the drilling that you've just announced $20 million bucks that you're about to go out and raise in the marketplace, and we'll see how quickly do you need that to close? I mean, you're good for money in the bank.
We're good for money in the bank. We're good for money in the bank. The idea is, as you know, your viewers will know, the markets are not great at the moment. And so we want to take those opportunities as we can. And we've put out a form of a gold note structure, which is less dilutive to the market versus an equity raise. So we're trying to get that over and get that done. So, but we have good money in the kitty. We have enough money to advance our project.
Right. And so tell us more about the gold note, just in terms, because we've heard lots of different alternative financing being done in the market at the moment. And obviously dilution is a big concern, especially when you're probably not values where you think you need to be, and off the back of what we're talking about. So how does this note work?
Well, a gold note structure is like a fixed debenture, effectively, but paid back in gold, really. And it's paid at an interest rate. However, the kicker is that there's a floor price set in of $1,800 gold. And any gold upside, the investor gets, really. And that's kind of how it works. It's a 12% interest rate paid over 7 or 8 years, and at a gold price of 1,800 floor. So if you believe in gold and you believe in the future, it's quite a good piece of paper. Even at today's gold price, it's yielding about 15%, And so we have warrants included as well. So it's quite a good return for investors as a piece of paper. But more importantly for investors in the company, it's not very dilutive sort of a structure. It's at least it's 70% less dilutive than doing an equity raise.
Right. And so given the nature of it, that's going to be sort of institutional focus, right? So retail. Yeah. Okay.
Yeah, mainly institutional, high net worth people as well love this sort of structure because it's a play on the gold price. So they're the two main funds we're looking at. Yeah.
Okay, structured finance in a difficult market, you got to do what you got to do, right? So, in terms of what that's going to allow you to do, you sort of laid out this sort of 15, 18 months worth of drilling to get you the information that you need to make a bit more of an informed decision about how you actually go about mining this. So it's underground. We've talked lots of times about underground mining. You're going to need 4 grams per ton minimum. So when do you start making decisions about cut-off grades and sort of the economics around that?
Yeah, so we've just kicked off a pre-feasibility study. One of the challenges of the last structure, you might remember, is they did a study with a company called JDS, a final study, and unfortunately it wasn't to the level that I would say is good. I looked at it. There was a lot of flaws in it. that needed to be addressed. So we've decided to take the conservative approach after this drilling, step back and redo that study with a different group. So reset the bar really on the project.
Well, talk to me about the importance of this. I think it's really important for people looking in understand why it's important to you and why it should be important to them. Obviously, we did a similar sort of commentary with regards to JDS. Sometimes groups, these consultants are incentivized to pretty much say what the company wants them to say. So why have you got to go for good quality consultants, and why should the market care? Who does it?
Yeah, well, it was a couple of trades for me that you might have seen, Matthew. SRK did all the preliminary work on the project. They did all the resource work. However, they left SRK to go to JDS, at the right time. And it's very rare that happens. You usually have one group who own the project all the way through. It's very important to have that and quality. And also during that time, there was a couple of different resource updates. So that all gives me red flags about there was a lot of movement of consultants, and sometimes groups who don't get what they want, they go to a different group and the group gives them the right answer, if you know what I mean. So it's very important for investors and people to really deep dive and see the trail of events and understand that you have good consultants with good reputation doing those studies. And unfortunately, JDS, I don't know, your viewers might not, they have a bit of they've done a couple of studies and they've had some issues with those studies. But that's what we saw very clearly, that it wasn't up. And for me, as coming in, my background, I wanted to kind of really own the project again and be involved and make sure I have ownership of the decisions that are made. So that's why we wanted to step back and reset the bar really as we go forward.
Well, I don't think this project can afford any missteps. Yeah. Can it? You're under a spotlight here, not because of what you've done, but because of what's going before. But so that process will take how long? And how much money will it cost to actually be able to deliver that? The feasibility will be done by the end of the year. Pre-feasibility we're going to do by the end of the year. The money that we have now, will get us the majority of that way just to get the study out of it. But we will need to go and raise further money on the project to get us fully into production. Right. Okay. So, and again, it's this part educating the audience and perhaps, maybe even a new audience to the company, which is around what you will be aiming for. Because like before, I think JDS, they had a cutoff of about 4.75, something like that. Great. But they didn't quite get, that didn't eventuate. So in terms of, what you think is going to be important to be able to demonstrate to the market come the end of the year? What are the things that we should be looking at? You may not have the numbers yet, but what should we be looking at?
Yeah, I think as the market is watching us, the drill results we get over the next few months will give an indication of the new areas of the ore body, and the continuity of that ore body. Where they went in was some area that had lack of continuity. And once people can see that, then the mine design is very important, getting that right. And I would suspect a lower cutoff is better, just giving the nature of the ore body, giving the complexity, and also the size of the way they were going to mine. They were going to do very high production mining, very big stopes, very big tonnages. And unfortunately, in Red Lake, that's not the ideal way to mine. The vein, you need to be selective. You need to tailor your mine to the ore body. There's a saying, you need to build a mine around the ore body, not the other way around. So you need to have selective mining methods. You need to be able to make sure your grade is getting in there. You need to have all that selectivity. And unfortunately, because of that, you might not get the tons you desire and the production, but it's more important to get the ounces, in my opinion, and scale up the project. Go slowly. You can always upgrade and upscale the project, but I think we need to start off slow, start going, and build from there.
Right. So, how do you communicate to the marketplace? Because I think you've kind of got a decent representation on the board of people who can get access to institutional money, but there's also still kind of big kind of retail component which is going to be important to you in terms of that liquidity and trading and so forth. And companies like yourselves do like to report big high-grade numbers in the headlines. because that's the sexy bit, that's the sex and the sizzle. But the reality is how it all kind of comes together, and and how you kind of model out not just the drill program, but the ore body itself. So, slide aside, one CEO described a company in a similar position to you, where it's kind of got a lot of high grade, thin, narrow vein type stuff. He said, like, if you can imagine those veins as carrots, it's like taking a bag of carrots up in a helicopter at 1,000 feet and dropping it on an ice rink. That's how hard it is to kind of piece together the gold in an economic sense. So for you, that journey of piecing it together, you described the way you're going to come at it. But can you talk to me about the way that you're going to report the drill results going forward in the news releases?
Yeah. So, the key is for any of your viewers, actually, everyone loves to promote the high grade thing. It's more for us on the widths. The widths are very important of the high grade hits, because you can have a 400 gram high grade hit. If it's 0.1 meters, 0.2 meters, it means nothing. So it's very important for viewers to understand the widths, the mineable widths. Typically underground mining stopes are 2 to 4 meters wide, sort of mineable, that sort of range. And so you want to be seeing these high-grade hits with good mineable distances of those sort of 7 to 8 grams. That's kind of what you will build a picture up as you get that. Because when you can put all them together, then you can build a mine plan around it. But as you said, carrots on an ice rink, you can't really pull together. And particularly in underground mining, it takes a lot of work to get to each different carrot, a lot of costs, a lot of development, a lot of ore to move, a lot of waste to move, and that becomes very challenging. So it needs to all hang together, and drilling and definition and mine planning are the key to that. So the mineable widths are key.
Right, okay. And I think you've sort of touched, well, you've certainly intimated this, and we always like to sort of look at the sort of input cost parameters, right? In terms of when you're putting this pre-fees together, making sure you kind of got real world comps. And especially like during this time, this obviously Pure Gold previously was in the early stages of, COVID and some of the difficulties that prevent. We've kind of run through COVID and hopefully I think out the other side now, except on the cost basis, right? We've got a lot of CEOs talking to us and saying, look, there's a new cost reality out there. People must expect a higher AISC and higher costs associated with this. You've got a slight advantage in the fact that you pay $6.5 million for this thing. That helps. But are you kind of conscious of those input cost parameters, and and what are you looking to try and control or understand better?
Yeah, look, all you have to do is look at the quarterly results and the yearly results that are out now. 1,000 is no longer the AISC. Most of them are pushing up towards 1,200, 1,300 AISC of the mines. And look, we're in Ontario. There's a lot of mining going on in Ontario. A lot of big Agnico, big companies with mines in the region, and all doing successful. So there's good benchmarks for us to look at the costs. Labor is probably 60% of the cost in our mining operation. So that's pretty much fixed. It's a standard labor rate, so that's I think the key area will be the consumables, drills, bits, consumables, chemicals, and they are moving up. We are seeing that. And in reality, they haven't really come back down. They went up during COVID and the supply chains, but we haven't seen them come back down. And the other advantage we have is because we're now underdeveloping, we have 100 people on site, we're dewatering, we have actual costs. We have actual real costs. We know how much it costs for power, fuel, electricity. They're actual costs that will go into our studies. It won't be like a green field where you do a study, pull in a lot of assumptions and go, well, this is what we think it will be. We have 100 people on site today working. We have equipment, we're drilling, we're blasting, we're building chemicals, we're water treatment. They're actual costs on the ground that we will use as a basis for our study. So you're really getting a much higher level of confidence of a study. You're getting actual costs actually into the study.
Right, okay. You are painting a picture of someone who's realistic about the world out there. This is not a case of this is a golden goose, which is going to just deliver money for everyone and all concerned. This is a mine which we're going to get back into production, and we're going to do it economically. Mining's hard. Little fires need to be put out every day. but we've got a plan.
Yeah.
That's what it feels like to me.
Exactly. Well, as your viewers will know, there's not much golden goose in mining. It's a tough slog to build a mining project. It takes time. It takes patience. It takes effort. And you need to do it right. Look, I've been doing this for 25 years. Today, it takes 7 to 10 years to build a mine into production. Pure Gold have been through a number of years. We're kind of taking it and we're getting the last elements. Actually, your viewers, in the last 6 months before they got into production, they actually began to turn things around. We saw that. We have the production records. They brought in some good people at the end. They brought in a few people who knew what they were doing. They just began to turn it around. So that gave us hope that it was possible and they were there. But again, our reality is, let's do this realistically. The market has a lot of skepticism around this asset, as you know, and we've got to prove and demonstrate to the market we're not looking for a massive, tier 1 operation. Right, let's get into production. Let's do it consistently. Let's get a base going and build from there. That's kind of the model we're trying to achieve.
Right, and I think it's a good point that you make about the kind of debt that was taken on board, and perhaps the leasing component has played a big part of that. And we've seen Wyloo and Mincor, we were talking to bankers involved with that. The structuring of the deal at the beginning is so important. Otherwise, it creates a huge negative hangover on the company. And I guess the question comes with is, why weren't Sprott willing to have a negotiation with that team? Why are they doing it with you after the event?
Well,
but I guess we'll never know. We'll never know. I'm not going to push you.
We'll never really know. We'll never really know why that came about. But I will say, that, and this is your viewers will know, debt in an early stage development project anywhere in the world is risky. Is risky because, developing projects is tough. You have permitting challenges, you've capital overruns, you've risk, you've inflation, you've people issues, you've construction risk, and all that doesn't really suit a debt profile structure because it's all uncertainty, and debt is about certainty. So the two of them don't really match well. So, our plan is to avoid debt on this as long as possible to kind of do it. Unfortunately, we have to do equity, which obviously is a balance to that. But I would much rather do that than take on debt again, because otherwise our investors will go, hey, they failed because of debt. Why are you doing exactly the same? And we need to show we're doing it different.
Well, look, Shane, there's a nice reintroduction. It's fairly high-level stuff today, and I'd love to get into the weeds with you a bit more of a technical conversation next time round. But appreciate your time today. We'll hopefully bump into you at PDAC. Looking busy out there. And appreciate your time. Thank you very much.
Excellent. Thank you very much, Matthew. Thank you.